So there's an expectation if you are investing in a private equity fund, typically, family offices, wealthy individuals, sovereign nations, a number of different ways that private equity funds are constructed with different types of investors make up this capital. So if there's an expectation of a 3 to 5 year kind of recap and that does not happen, do they get pressure from the investors also to hurry up?
Great question.
Yeah. So how does that work?
So it's really interesting. So those investors are called LPs, right? And those limited partners in those investment groups, that they're getting pressure on both sides. So the people who already own an asset, like a DSO, are saying, why haven't you transacted? We would like liquidity, please, right? And then the people who have invested in that next round of funds have said, well, why haven't you invested as much as you could have invested at this point? All this money is just sitting there, right?
Yeah.
And both of those actually do the opposite of what is in the best interest of the private equity group, which is going to be diminished returns. So the money becomes more expensive over the course of time because you've guaranteed these investors certain rates of return. And it also pushes out the time horizon, which ends up decreasing your overall percentage return, your IRR on the deal. And so long story short is, yes, they're both getting a ton of pressure, and the pressure is mounting for this deal overhang to suddenly pop. It just hasn't yet. And there's a lot of people who have written white papers on the reasons why. I don't think we know the reason why, honestly, at this point, but there's a lot of deals that essentially are primed to go and a lot of investable capital that is out there. And soon the two shall meet is the long story short.